Good morning, everybody. Aquatic here with the Real Report. You guys probably saw this morning's CPI print, so that's what we're going to cover real quick. Stay tuned. Also, leave a like, comment, and subscribe. Really appreciate it, guys. Shout out to everybody in all the new locations, which I'll read off in the next video. Hopefully do a double feature today. I wanted to start us off by a message from our Commander-in-Chief. Here you go.
Percent. Actually, I just want to say a number. 0. Today, we received news that our economy had 0% inflation in the month of July. 0%.
Ooh, man, that was an interesting one to wake up to. Gave me a good laugh. All right, guys. U.S. consumer price inflation slows in July, but real wages continue to tumble. U.S. consumer price inflation is expected to slow from 9.1% to 8.7% year over year. It actually slowed more, down to 8.5%. Whoop-de-doo. Ending a 16-month streak of month-over-month gains. Reading that number is just absolute insanity. 16-month over month gains. Sheesh. Core CPI, excluding food and energy, however, was expected to reaccelerate, rising from 5.9% year over year to 6.1% in July, but instead deaccelerated to 5.9%, aka 0.2%. Services inflation continued to rise, but energy and good prices slowed. Energy prices tumbled month over month, driving by plunge of gasoline prices. Fuel oil was down 11%, gasoline down 7.7% among the biggest drivers. Shelter costs, however, continued to rise 0.5%. The shelter index continued to rise, but did post a smaller increase than the prior month, increasing 0.5% in July compared to 0.6% in June. The rent index, however, this is a big one, rose 0.7% again in July, and the owner's equivalent rent index rose 0.6%. So inflation, well, some things have temporarily cooled. The medium volatility indexes are still rising. The index for lodging away from home continued to decline as tourism and traveling have dropped. The shelter index rose 5.7% over the last year, accounting for 40% of the total increase in all items, minus food and energy. This was partially offset by the modest drop in used car prices, which we covered a few videos back with the car bubble imploding, so hopefully those continue to come down as the average car price is $48,000, which is astronomical. Unbelievable. So hopefully those continue to implode lower as the repos increase. Finally, and perhaps the most importantly, real average weekly earnings continue to plunge, now down 16 straight months as inflation eats away at any wage gains. Again, guys, real average weekly earnings down for the 16th straight month. So inflation, we're still not caught up, not even close. Is this drop in CPI big enough to signal a Fed pivot? One look at rate hike odds shows a collapse in tightening expectations, which are playing out broadly across markets where risk assets are soaring and yields are crashing. Some of the comments here, which I thought were worth reading: fake numbers about a fake economy to prop up a fake president. Banana Republic, here we are. How about the fake country, trusting fake voting, build on fake wealth, living in fake freedom, and 40 years of the same, who could still be angry? Past 40 years, noteworthy comment: China pulled 1 billion people out of poverty, Russia pulled 100 million people out of poverty, and the U.S. Gov shoved 100 million people into poverty. It's probably a conservative number. Hopping on over to Wall Street, reacting to today's huge CPI miss. Huge is a deceiving word, but noteworthy quote: remember that 1 month does not make a trend, but also remember that every trend starts with 1 month. Scrolling down here, you can see the bears today. That's essentially their life, is a crash dummy. This tremendous market reaction where, when one strips away the rhetoric, all we have seen is 1 month's drop in energy prices, which will only rise now that the market is starting to anticipate a Fed pivot. Bloomberg asks a similar question, namely, what's behind the surprising slowdown in July? They note that U.S. inflation decomposes into 4 factors. Those are supply, demand, energy prices, and monetary policy. The model found that lower energy costs and slightly tighter Fed stance were the main drivers of the deacceleration to 8.5%. At the same time, sizzling demand paired with supply constraints continue to put upward pressure on inflation, with the last 2 factors harder to contain. They noted that the Fed has a tough task ahead of it and will likely need to be more hawkish than currently expected. Some hot takes from some other economists. I trimmed out the fat, and here's the noteworthy takeaways. Higher interest rates will have a huge impact on housing and CPI soon. We'll see housing costs gradually subside for sure, core goods stabilize, and consumer purchases driven mostly by pandemic reopening. Revenge spending. I wanted to highlight this one. This is the most asinine, brain dead take that is a reoccurring theme from all economists. Pandemic reopening, revenge spending. The pandemic was 2 years ago. They're talking about stimulus checks people got. The people who qualified for stimulus checks spent those checks within 1 or 2, maybe 3 months max, and that's being conservative, well over 15, 20 months ago. So, this tells you about all you need to know about economists when they tell you absolutely moronic things like revenge spending by pandemic reopening, see material price retrenchment as inventories rebuild. Okay, 2020, it's now the 8th month of 2022. It's not rocket science here. The only real wild cards are supply risks associated with oil and gas, bleed over impact on food, think fertilizer and food transportation costs, which are still very prevalent, and the main drivers behind high food inflation. Let's see. Coming in off the wire right now, Biden signs bill aiding veterans exposed to toxins. Interesting. All right, back to the economy. We are at the point where the annual year-over-year CPI figures cease to have any meaning. Exactly what I was thinking. Prices are what they are now, as are wages and incomes. The only issue is where they go in the future, and what is not a function of expectations. It is the discipline of supply and demand. 71.8% of the CPI basket is increasing in price at more than a 4% on an annualized basis from the month-over-month data, which represents relief for the Fed after June's high of 74.8%. But what do other market watchers and strategists think? Below, summarized a handful of hot takes from across Wall Street. I've highlighted the key takeaways. And then we're going to hop over into the Inflation Reduction Act, so you guys don't want to miss that one. Robbing Peter to pay Paul. That's what that one's all about. Anyway, recession inventory, semiconductor warnings, fading this on the risk side of the equation. We've got getting into Q4 earnings growth will show clear signs of struggle and inflation. The key takeaway here being giving markets an important reminder that further rate hikes are absolutely necessary. Over here, issue really boils down to the labor market, and wage growth is running red hot, and absent a turnaround in productivity, this will ultimately fuel higher prices, higher inflation, because that's the thing. You raise wages, they've got to come from somewhere. Products go up, wages no longer cover the inflated price of goods. Another soft print is likely in August as gasoline prices have continued to decline as we drain the SPR and ship it overseas. But the medium volatility sector continues to jump higher, so that's a big concern. The better than expected core CPI print will be a strong positive for the Treasury market. That said, this report makes a 50 basis point more likely at the September meeting rather than 75, but a lot will depend on the August CPI release this month. You can think about this print sort of like the weather. It's better today than it has been over the past few days, but it's still summer. There's a lot of humidity. Interesting analogy. And to wrap this article up, while this has to be celebrated, 8.5% inflation is still well above what the Fed wants to see. A 50 to 75 basis points are still on the table for September. Some of the hot takes in the comments: 8.5% is still an ugly number, a fake ugly number at that. Something that's also what I've been preaching for months. Always assume 10% tacked on to any number they give you. And come on, why the sad faces and sour moods? You should be so happy about 8.5% inflation and 16 consecutive months of declining wages. Come on, what joyous news we have had bestowed upon us. The recession that never happened is over, and inflation that was transitory is finally transitioning. And to wrap up today's short take before the lunch hour, hopefully we'll get a second video out later, but Inflation Reduction Act will increase middle class small business taxes, tax law expert says. This one I just thought was ridiculous. You saw the other day, more spending begets more spending, and an Inflation Reduction Act that spends hundreds and hundreds of billions is just funny. While Democrats insist the Inflation Reduction Act won't boost taxes on people making less than $400,000 a year, collateral effects from the legislation will cause workers and small businesses alike to pay more. The Democrats serves to fulfill a series of broad Democratic aspirations, increasing federal revenue by closing so-called tax loopholes, enacting climate change policies, and expanding the Affordable Care Act, and reducing prescription drug prices. I'll give them the benefit of the doubt on that last one because it's something Trump was also working on as pharmaceuticals continued to rip people off on ridiculous profit margins and price gouging. So pharmaceutical costs do need to come down. Its supporters say the legislation will help to slow the growth of the ballooning U.S. national debt by decreasing the deficit. However, they're authorizing $433 billion in new spending. Who would have thunk? Democrats' internal estimates suggest that the bill will bring around $725 billion in new revenue by continuing to rape and pillage their constituents. There's nothing in here specifically targeting income levels. Brasher said they're not targeting people making $400,000 or more, but that's not necessarily true because corporations are the one paying taxes, but ultimately that has to be paid by the people. Like I said, you want to tax the companies more, the products are going to cost more, and then you have to pay more. And with wage inflation still on the decline, or I should say your real weekly wages on the decline and wage inflation not keeping up with the actual inflation, well, you're really just spinning your wheels. It's coming out of everyone's pocket that's involved in that operation, whether you're a worker, if you buy the products, if you have any stock in the companies, or if you have a 401k, it's going to affect you. They said applying general taxes across the whole economy is essentially what this is. They even said, quote, these are going to be taxes that are just kind of economy-wide. Says the fool who knows nothing about economics. Schumer. Individuals below the 400,000 threshold will see an increase in how much they pay. No duh. Like I said, robbing Peter to pay Paul is this headline. They're expanding enforcement of tax law by the IRS. They're going to expand audits on individuals and businesses. He said nothing. The appropriation of $80 billion to bulk up the IRS. Another $80 billion to the IRS. Nice. IRS will bring in an additional $124 billion annually through enforcement efforts. So, if anything, more of that weight is probably going to hit small businesses because they're saying if you're a sole proprietor and you're keeping your own books, it's probably just going to be harder for you to keep up with the convoluted tax code. So, that's all I got for you guys right now. We're going to have a double feature this afternoon, so leave a like, comment, and subscribe with that notification bell. Really helps me out. Thank you guys for being here.